This is a lithium-ion battery cell, the kind that powers your phone, your laptop, your cordless drill, and increasingly, your car. Inside this cell, there are approximately 8 kilograms of lithium carbonate equivalent per kilowatt hour of capacity. A typical electric vehicle battery pack contains 60 to 100 kilowatt hours. That's 480 to 800 kilograms of lithium per vehicle, roughly half a ton of a metal that, 2 years ago, was the hottest commodity on Earth. In November 2022, lithium carbonate traded at $84,000 per ton. Analysts predicted $100,000 was inevitable. Mining companies launched expansion projects. Governments declared lithium a strategic resource. The green energy revolution had found its limiting reagent, and that reagent was printing money for anyone who could dig it out of the ground. Then the price collapsed. By January 2024, lithium had fallen to $13,500 per ton, an 84% crash that wiped out hundreds of billions in mining company valuations and left expansion projects stranded mid-construction. Today, lithium trades at $21,000 per ton, still down 75% from the peak, still in what most analysts call a buyer's market, still cheap enough that battery manufacturers are rebuilding margins they lost during the 2022 spike. And yet, at 7:30 a.m. Hong Kong time on Wednesday, Goldman Sachs published a research note projecting lithium at $95,000 per ton by late 2026. Not a recovery to previous highs, a spike that exceeds them. In a market where EV sales growth has slowed from 60% annually to 12%, where battery inventory is piling up in Chinese warehouses, where every visible indicator suggests oversupply. The note wasn't written by junior analysts guessing at commodity cycles. It was authored by Goldman's head of battery materials research, the team that correctly called the 2022 spike 6 months before it happened. When they speak, institutional capital listens. $95,000 lithium while EVs stall. It sounds like a contradiction. It's actually the most logical outcome once you understand what's really happening beneath the surface of the lithium market. Here's what they're not telling you. The lithium price collapse wasn't caused by weak demand. It was caused by supply flooding into a market that couldn't absorb it fast enough. Supply that is now being systematically destroyed. Between 2021 and 2023, lithium mining capacity expanded by 340%. Every major producer, Albemarle, SQM, Ganfeng, Tianqi, raced to bring new production online. Australian spodumene mines opened at record pace. Chilean brine operations expanded capacity. Chinese lepidolite processors scaled up. African projects that had been stranded for years suddenly found financing. The expansion was rational at $84,000 lithium. At $84,000, even marginal deposits were profitable. At $84,000, the economics justified fast-tracking projects that would have taken a decade under normal circumstances. Then the price fell to $13,500, and the math inverted. At $13,500, the average Australian spodumene mine loses $3,200 per ton of lithium produced. At $13,500, Chilean brine operations break even at best. At $13,500, African projects that raised capital assuming $50,000 prices face immediate insolvency. At $13,500, the supply expansion that seemed brilliant at $84,000 becomes a value-destroying catastrophe. The supply destruction has been swift and brutal. Core Lithium, Australia's newest producer, entered administration in February 2025. Piedmont Lithium suspended its North Carolina project indefinitely. Sigma Lithium cut production by 40% and announced strategic review. Liontown Resources deferred its Kathleen Valley expansion. Across the industry, projects representing 380,000 tons of annual production capacity have been canceled, suspended, or delayed since mid-2024. That's 380,000 tons of lithium that the market assumed would exist by 2026 and now won't. The demand forecasts that justified those projects haven't changed. Only the supply forecasts have changed. The gap between projected supply and projected demand, the gap that determines price, is widening even as the spot price suggests surplus. Goldman's $95,000 target isn't based on demand acceleration. It's based on supply destruction intersecting with demand that continues growing, just more slowly than the hype cycle suggested. This is where the lie becomes unsustainable. The EV slowdown narrative that dominates financial media fundamentally misunderstands what's happening in electric vehicle markets. Yes, EV sales growth has decelerated. From 60% year over year in 2022 to 35% in 2023 to 22% in 2024 to a projected 12% in 2025. The hockey stick adoption curves that justified trillion-dollar valuations for EV companies haven't materialized. Tesla's growth has stalled. Legacy automakers are scaling back EV commitments. The narrative has shifted from EVs will dominate by 2030 to maybe EVs will take longer than expected. But here's what the narrative misses. 12% growth is still growth, and 12% growth on a base of 14 million vehicles sold in 2024 means 15.7 million vehicles in 2025, 17.6 million in 2026, 19.7 million in 2027. Each of those vehicles needs 500 to 800 kilograms of lithium. At 700 kilograms average and 17.6 million vehicles, that's 12.3 million tons of lithium carbonate equivalent demand in 2026, up from 10.8 million tons in 2025 and 9.1 million tons in 2024. Demand is growing, slowly, steadily, without the exponential trajectory that drove the 2022 mania, but growing nonetheless. Supply, meanwhile, is contracting. The mines that closed at $13,500 aren't reopening at $21,000. The projects that were canceled aren't being revived. The expansion capital that fled the sector isn't returning. The destruction that happened over 18 months takes 3 to 5 years to reverse, even if prices rise enough to justify reinvestment. The Goldman model shows supply of 11.4 million tons in 2026 against demand of 12.3 million tons. A deficit of 900,000 tons, roughly 7% of the market. That deficit, in a commodity with limited above-ground inventory and concentrated production, is enough to drive prices back toward previous highs. But the model contains a variable that most analysts are ignoring: energy storage. Electric vehicles get the headlines, but stationary energy storage is growing faster, consuming more lithium, and shows no sign of slowing down. At 2:15 p.m. Beijing time on Thursday, China's National Energy Administration released 2025 grid storage installation data. Total new capacity, 187 gigawatt hours, up 67% from 2024. At 600 kilograms of lithium per megawatt hour, that's 112,000 tons of lithium demand from Chinese grid storage alone. The United States added 23 gigawatt hours of grid storage in 2025. Europe added 18 gigawatt hours. Australia, which needs storage to balance its massive solar build-out, added 11 gigawatt hours. Home battery systems, Powerwalls, Enphase batteries, LG units, added another 9 gigawatt hours globally. Total energy storage lithium demand in 2025, approximately 480,000 tons. By 2028, if current growth rates continue, that number reaches 1.4 million tons. Energy storage is becoming a demand driver that rivals EVs in lithium consumption, and it's growing faster. The storage build-out isn't optional. Renewable energy is intermittent. Solar produces nothing at night. Wind produces nothing when the air is still. Grids that depend on renewables need storage to match supply with demand. Every gigawatt of solar and wind capacity requires backup storage capacity. The more renewables the world installs, the more storage the world needs. The more storage the world needs, the more lithium the world consumes. This is the demand driver that the EV slowdown narrative ignores. EVs might grow 12% instead of 60%. Storage is growing 67%. The combined demand trajectory, EVs plus storage plus consumer electronics plus industrial applications, continues upward even as the most visible category decelerates. When supply contracts into accelerating demand, price spikes don't wait for deficits to materialize. They anticipate them. The lithium market learned this in 2022. Prices didn't spike when inventories hit zero. They spiked when forward curves showed inventories would hit zero in 12 months. Buyers who needed lithium for 2023 production started securing supply in early 2022. Their buying drove prices higher. Higher prices attracted more buyers who feared further increases. The anticipatory buying created the spike before the physical shortage arrived. Goldman's $95,000 scenario assumes the same anticipatory dynamic returns. Battery manufacturers who see the supply destruction, who model the storage build-out, who understand that projects canceled at $13,500 aren't coming back at $21,000, those manufacturers start building inventory now. Their buying puts upward pressure on prices. Rising prices validate the decision to build inventory. More buyers enter. The cycle repeats. At 11:30 a.m. Seoul time on Wednesday, Samsung SDI announced a lithium procurement agreement with Australian miner Pilbara Minerals that locks in supply through 2030 at prices linked to spot, but with a $35,000 floor. Samsung is guaranteeing a price 67% above current spot to ensure supply security. When major battery manufacturers start paying floors that high, they're telling you what they expect the market to do. CATL, the world's largest battery manufacturer, has been aggressively securing lithium supply for 2 years. They've acquired stakes in Argentine brine projects, Australian hard rock mines, and African deposits. They're not waiting for the market to tighten. They're positioning for a tightening they consider inevitable. Less than 11 months remain in 2026. Goldman's $95,000 target is for this year, not a decade from now, this year. The supply destruction has already happened. The demand growth, while slower than projected, continues. The storage build-out is accelerating regardless of what happens to EV sales. The gap between supply and demand is opening. While one side destroys supply, the other side builds inventory. The strategic behavior of major lithium consumers tells you more than any analyst report. China controls 65% of global lithium refining capacity. Chinese battery manufacturers dominate global production. Chinese automakers, BYD, NIO, XPeng, are the fastest growing EV producers on Earth. When China's lithium strategy shifts, the global market shifts with it. At 4:45 a.m. Eastern on Friday, Chinese customs data showed that lithium carbonate imports increased 34% year over year in December, even as domestic production rose 12%. China is importing lithium faster than its production is growing, building inventory while prices are low, preparing for a supply environment they expect to tighten. The imports aren't going into batteries. Chinese battery production grew 18% in 2025, while lithium consumption grew 27%. The excess is going into strategic reserves, government and corporate stockpiles that don't appear in visible inventory statistics, but remove material from the tradable market. Every ton that moves into Chinese strategic reserves is a ton unavailable to Samsung, to LG, to Panasonic, to the Western battery manufacturers competing for supply. The hoarding that Chinese entities are conducting at $21,000 reduces available supply for everyone else. When supply tightens and prices rise, the hoarders have inventory. The non-hoarders have procurement crises. This is the game theory of commodity markets. The rational strategy, when you expect prices to rise, is to build inventory before they rise. But if everyone builds inventory simultaneously, the inventory building itself causes the price rise. The expectation becomes self-fulfilling. The anticipation creates the outcome it anticipated. This is what a supply-driven price spike looks like before it happens. Not demand mania, not speculation fever, just math. Supply was destroyed at low prices. Demand continues growing. The gap widens. Anticipatory buying begins. Prices rise. $21,000 today. Maybe $35,000 by summer. Maybe $60,000 by fall. Maybe $95,000 by year end. The trajectory depends on how quickly buyers recognize the supply destruction and how aggressively they respond. Some will look at $21,000 lithium and see stability. Will trust that the 2022 spike was a bubble that won't repeat. Will assume that EV slowdown means lithium demand is peaking. Will believe that $95,000 is impossible because it sounds extreme. These are the same voices that said $84,000 was impossible in 2021, that said $13,500 was the new normal in 2024, that said supply expansion would permanently suppress prices. The voices are always confident about commodity prices. The commodity doesn't care about confidence. Others will track the project cancellations. Will count the mines that closed. Will model the storage build-out that's growing 67% annually. Will notice Chinese import data showing strategic accumulation at low prices. The informed are not predicting $95,000 lithium on any specific date. Commodity markets are too complex for precise timing. What the informed recognize is that the conditions for a spike are forming, that supply destruction has exceeded what demand deceleration can offset, that strategic positioning has begun, that the market, which spiked to $84,000 on less severe fundamentals, could spike higher on worse ones. This is not financial advice. This is not a recommendation to buy lithium stocks or battery manufacturers or take any position based on Goldman price targets. This is simply an observation about what happens when an industry destroys 380,000 tons of supply capacity, while demand grows 12% and storage grows 67%. The EV slowdown is real. The lithium math is also real. They're not contradictions. They're different parts of the same equation. Slower EV growth means slower demand growth, but slower is not negative. Supply destruction means less supply, period. When you subtract declining supply from still growing demand, you get deficits. When you get deficits in concentrated commodities with limited inventory, you get price spikes. $95,000 is Goldman's number. The physics of supply and demand will determine the actual number, but the direction is clear. The destruction has happened, the deficit is forming, and the price that balances a market where 380,000 tons of supply disappeared isn't $21,000. It's whatever price brings that supply back, and that price is much, much higher.